As you guys know, stocks is a very popular means of making money in the financial markets. But there's definitely other options out there. See what I did there? So today I'm going to teach you guys everything you need to know about the world of options. Let's get right to it. First thing you guys have to know is that options are derivatives. Not that derivative, but this derivative. And derivatives are contracts used to trade financial assets. And their value is very dependent on the asset they're representing. Just think of the derivative as another way to trade the asset class. And it gives you much more flexibility in terms of trading it and investing it overall. Okay, so now the reason why you guys clicked on this video. Options, like we discussed before, options are derivative contracts. But in the case of options, it gives you the right, but not the obligation, which is the most important part, the right or not the obligation to buy or sell a security at a given price, called the strike price, before an expiration date, which is determined by the contract you buy, and you should know that when you buy the contract. This means when you buy an option by paying the premium, which is also known as the price of the option itself, you don't have to execute the contract or execute anything before or at the expiration date. It's really your choice after you buy the option, which gives you a lot of advantages if you think about it, and we'll be covering it later in this video. In the financial world, there are American options and European options. And there's only one main difference between the two. In American options, you can exercise the contract anytime before the expiration date. While European options, you can only exercise the option, which means execute the option, activate it, at the expiration date, which is a very important difference. Now, there are two types of options that you'll be working with: puts and calls. Puts allow you to sell, also known as short a security, at a given price and before the expiration date, while the call does the same thing, but vice versa. While the call allows you to buy the security at a given price before the expiration date, which pretty much represents the two types of strategies you can use when trading options. Obviously, you can use this in various other ways, but those are the two main order types of options. Puts and calls are part of the most important things to understand and take away from this video, because they are literally the foundation of any type of option trading. They're the orders that you use when trading options, and it's just an important thing to know. If you want to sell or buy anything, you gotta first know what puts and calls are. You must be wondering, why am I in my mom's closet right now? I'm honestly wondering that myself. Another important thing to understand is the difference between buying and selling option contracts. Very important. Buying options is probably the most common way that normal everyday people trade options, and we have already covered that a couple minutes ago, so I'm not going to explain what that is again. So we're going to go right into how selling options work. Explaining how selling options work in terms of puts and calls, the foundation of option trading. When you sell someone a put option, you sell them the right to force you to buy a certain amount of shares from a company at a specific price from them. You sell someone a call, you sell someone the ability to force you to sell shares of a company to them at a specific price before the expiration date, which is important concepts to know, because then it will be affecting how you're going to be trading it. Either you're going to be selling these option contracts or actually you're going to be buying them. And there's definitely a lot of strategies and ways to go and approach both of them. And there's not really a right and wrong way. There's definitely pros and cons of both. And in exchange, the seller gets paid the premium of the option, also known as, like I said before, the price of the option. And there's a lot of factors that determine the price of the option, which I may or may not have gone through in this video. As a seller, you make money on the transaction if the second party does not execute the contract. Because usually when they execute the contract, that means they made probably profit and override the premium. And it probably means that you'll be forced into a very unfavorable position in the security, which you'll probably be losing money on in the trade. Because remember, option buyers will not execute their contract unless the stock has moved favorably in their desired direction. And if it doesn't, and it goes the other way, they won't execute the contract at all. And that's the best scenario that option seller can have if they don't execute the contract at all. It's so nice to be back in my room. Anyways, so options trading these days is fairly easy and accessible, since pretty much every brokerage like TD Ameritrade and Charles Schwab's offers the service of options trading. More often than not, you usually have to apply to get the options trading right on your account. But usually if you can create a brokerage account and have margin onto it, you should be good to go. You should not have any problem setting up options trading on that account. But it definitely depends on what brokerage you're using. Every brokerage is different, but for the most part, it's very easy. And the marketplace that will be connecting you with the many and various option contracts out there is going to be the CBOE Options Exchange, also known as, or actually was known as, the Chicago Board Options Exchange. Yeah, mouthful. Chicago Board Options Exchange. There you go. It doesn't ring. I see why they changed it. Exchange has 5 requirements that a stock must meet in order to have their own options on their platform. And these 5 rules include: rule number 1, the stock must be registered with the National Market System. Rule number 2, it must have at least 7 million publicly held shares. Rule number 3, it must have 2,000 or more individual shareholders. The 4th rule is that the volume, or how many times the stock has been traded, needs to be at least 2.4 million shares in the past year. And the last and final rule is that the stock or the security needs to be at a high enough price at a specific period of time. And that's really it. And then the stock can be traded as an option on the CBOE stock exchange. The CBOE option exchange. Oh, okay. And one of the main advantages of trading options is that it gives you a much more stable way of mitigating your risks when it comes to trading securities, which is a very volatile market. Remember, when you buy an option, the maximum amount of loss you can accrue from the trade was the premium you paid for the option. That's literally it. If the stock or security doesn't go your way, just don't execute the contract. That's it. All in all, options are a very useful financial tool when it comes to trading different assets like stocks, commodities, and currency. And if you're interested, I would definitely do more research on it yourself to see whether or not this trading style fits your personality. And plus, it's just a good habit to get used to of when you learn something on the internet, do further research to confirm whether or not he's correct or not, or the source is correct or not, you know? So yeah, guys, that's the end of the video. Thanks for watching. Hopefully you guys learned a thing or two about options. Hopefully you guys don't roast my mustache too much. Dude, I literally just shaved it like a week ago. I don't know why it's still here. Anyways, I mean, maybe I should keep it. Who knows? Who knows? Should I keep it? Say in the comments, should I keep the mustache? If not, I'll shave it. I'll shave it in the next video. But yeah, that's it. Peace. Look at me, Mom. I do have friends. Huh. Huh.